The Australian economy is incredibly robust. The only thing that got us into a recession in the past 30 years is a very conscious effort from the federal government to put the economy into recession. Likewise, now on the other side of the pandemic, even talk of Trump and tariffs and the Ukraine and oil price wars, all of that dynamic, it isn't going to change the outcome that we do have a very resilient economy. If we're looking at the geopolitical dynamic, and we should always replace geopolitics with energy markets, there's no such thing as geopolitics, there's only energy prices. And that is a fascinating industry. What we're on now for Western Australia, yes, that stable employment growth. So in the absence of that capital infrastructure investment, the mining sector employment is continuing to grow. Their investment is continuing to grow year on year and is likely. So the older that capital gets, the increased maintenance and repair that goes into it, and the more people are employed in maintaining those facilities. What happens now is that you're going to catch the national tide. And for the first time in, I'm not sure when, Western Australia is going to join the national economy on a cycle of house price growth after 20 years of moving against being counter-cyclical.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
So, I'm pretty much getting asked on a daily basis, what is next for the Perth housing market? So, I thought I'd get one of the country's leading experts on. We've got Tim Reardon, the HIA Chief Economist, on the show to give us his insights on not just Perth, but Australia and where we sit globally with the economy, our housing market, and everything property. So, thanks for joining us, Perth. Tim?
My pleasure. Thanks for having me.
I said, thanks for joining us in Perth, but I really appreciate you coming on the show. Why don't we start top level and work our way down? How is our Australian economy going at the moment?
Well, look, we have to remember the Australian economy is incredibly robust. The only thing that got us into a recession at any time in the past 30 years is a very conscious effort from the federal government to put the economy into recession. And likewise, now on the other side of the pandemic, even talk of Trump and tariffs and the Ukraine and oil price wars, all of that dynamic, it isn't going to change the outcome that we do have a very resilient economy. So we could talk about all the global shifts in energy markets, and I find that fascinating, having come out of the energy side of things. But when we look at what's happening oil price-wise, oil prices low, that should be a positive for manufacturing in Asia. The US and tariffs is probably a negative for manufacturing in Asia, although I'm not sure that much can change in the short time frame. The US is still the world's largest consumer market, and regardless of what happens with tariffs there, that's going to be the dynamic, and they can't switch production out of China very quickly. So for Australia, that means that our export base remains fairly stable. Europe is looking for energy out of the Asian market at the moment, which is probably a positive for the short term for Australia. But that will see them invest into energy in North Africa, which is probably a negative. And whether manufacturing in China continues to grow unabated, or if there is a small disruption, it's still not going to change the outcome that a correction in Asia leads to increased demand for iron ore as a consequence of infrastructure investment. So from that global perspective, everything for our economy is reverting back to a reasonably stable outcome. Now, there are concerns with the domestic economy, of course, that while our economy is growing, it's growing very slowly. We're in a per capita recession. Household incomes are significantly lower than what they were pre-pandemic. And the nature of our economic growth now is very different. It's very reliant, very dependent on government expenditure. Now, in the short term, that's fine. The Australian economy is an incredibly large war chest to withstand shocks such as the pandemic. And this is the right time in the cycle for governments to be investing in infrastructure. Electricity generation, Snowy 2.0, Western Sydney Airport, and we need that infrastructure investment in order to stimulate economic activity coming out of the pandemic. And it is a positive for home building. We do need the infrastructure built, but it does create a few challenges. And one is that our economy and productivity in our economy is very poor. And we've seen now the Treasurer announce late last year his 5 pillars for economic growth in the future or productivity reform, I should say. And I think they're on the money there, but long term, we are going to have to see the economy growing through private sector investment, not through public sector investment.
Yeah, well, there is always a lot of things in the media for us to potentially get worried about. And I think being from Perth, people are worried about the potential slowdown of China and what that might mean for our resources. Can you speak to that a little bit more? Because there's a lot of different levers that can be pulled, and timeframes of how this might play out can be varied. So
yeah, economic growth in China has been slowing for a long time, but it has still remained positive, and now we're looking at 5 to 6% economic growth per year in China, down from the 10 to 12 it was a decade ago. But it is, of course, now off a much larger base. And the concerns about manufacturing in China, keep in mind that one of their major exports is electric vehicles and automotive, and growing at an alarmingly large rate. And what's happening in the United States, denying Chinese vehicle manufacturers access to the US market. They've never had access to the US market. So it's not going to adversely affect their electric vehicle production or exports. And then you see other markets, Europe, Canada, Mexico, probably opening up as a consequence of what's happening in the US market. So I'm less concerned about that dynamic. I think that if we're looking at the geopolitical dynamic, and we should always replace geopolitics with energy markets, there's no such thing as geopolitics. There's only energy prices. And that is a fascinating industry when we look at the United States' entry as now an energy exporter. What's happened with the sabotage of Nord Stream pipeline, Europe no longer, or looking to protect itself from its reliance on Russian gas and shifting to buying gas and other energy out of the Middle East and Asia. And now we've got Russia selling gas into China, and the Saudis are responding by, we've now got our first oil price war for the first time in a decade. So oil prices now well below what it cost the United States to produce oil. And so we're getting some very unusual repercussions happening as a consequence of the war in Ukraine and the United States' response to that, including seeing Canada now entering the market as being an energy exporter for the first time. They've always exported to the United States, but now they're about to open a gas export facility to export gas to China. From an Australian perspective, in the short term, that's positive. That's increased demand for gas. And so over the course of the next few years, very minor positives. But I think that the cycle we're on now is very different from what we have seen for Western Australia over the past 25 years, where there was that very lumpy investment in infrastructure, particularly iron ore in that 2005 to 2015 cycle, and East Coast in coal seam gas and in coal exports over the past 25 years. But the dynamic I see going ahead is that every country in the world is now protecting itself from narrow supply chains. And China in particular has done an excellent job of diversifying their energy imports. So they now have Canada, Australia, the United States, Russia, and the Saudis all competing to supply energy into China. The Europeans are trying to protect themselves from reliance on Russia by investing in North Africa. Of course, the Europeans have a long history of investing in North Africa, which hasn't always worked particularly well, and there's a lot of resistance to old European colonial powers investing in Africa at the moment. So quite how all those machinations flow, I couldn't be certain, but I don't think that Australia is going to get those unicorn investments that we have seen over the past 25 years. The Boyne Island investment, the investment in gas in Darwin, and Australia's iron ore, that they are one-off unicorn investments. What we see now is much more an ongoing, consistent demand, probably unstable prices, but all commodity prices are relatively unstable. But from a West Australian economy perspective, that roller coaster ride of the last 25 years appears to be over at least for the next 5 years. The prospect that there will be further investment in iron ore in Australia, I think, is slim. Further investment in coal is also slim. And coal seam gas or gas exports appear to be flowing to other parts of the world, Africa and Latin America. If there is an environmental revolution and we see demand for lithium, graphite, and other rare earths, again, I don't think that's coming to Australia. I think China, India, other parts of Asia are doing everything they can to protect themselves from their reliance on such a narrow resource base as what they've had over the past 20 years.
Well, I guess what you're saying there is we're not likely to see the same sort of roller coaster ride of resources that we've had previously, and it's not likely to flow through to the same roller coaster that we've seen in our property market, especially across that 2016 to 19, where we've understandably got a lot of investors that rode that roller coaster down, and they're hesitant about, is it going to go down again coming up at some point?
Yeah, that bust phase, that was a very deep and dark cycle for Western Australia. And a lot of the damage, a lot of the problems we have in the building industry at the moment are as a consequence, particularly of what transpired in 2019. The volume of home building, house prices collapsed well below what they should have naturally done because of just a loss of confidence. Once you're 4 or 5 years into a house price decline, what's another year? But it does cause quite a significant amount of damage. What we're on now for Western Australia, yes, that stable employment growth. So in the absence of that capital infrastructure investment, the mining sector employment is continuing to grow. Their investment is continuing to grow year on year and is likely. So the older that capital gets, the increased maintenance and repair that goes into it, and the more people that are employed in maintaining those facilities. So employment base in Western Australia should continue to grow at much more of that 1% to 3% per year. But where there is ongoing employment is in building and construction. So whether it is government expenditure, federal government or state government expenditure in infrastructure, that is certainly quite significant. There are a number of projects of state significance in Western Australia at the moment. But from a home building perspective, nationally and in Western Australia, we could certainly build homes at capacity without any impact on prices for at least 2 to 3 years. That is, the pent-up demand that exists for homes in WA and nationally will take us 2 to 3 years with zero migration in order to service that. And then when we look at how significant demand is growing, demand for housing comes about from just two factors, and it's population growth and the average number of people per home. And so as we get rising wealth, people want to have fewer people per home, and that rise in employment will see interstate migration and overseas migration continue. And while that transpires, there is no time in the next 5 years where we see that the number of homes that are being delivered in any 1 year meets demand in that year. So looking through at least till 2030, every year demand will outstrip supply.
Yeah, wow. You touched on population growth there. What's likely to be the projections for Australia, and what sort of share do you think Perth's going to continue to get? We've had a higher than average portion as percentages coming to Perth, I guess, driven by affordability, lifestyle reasons, as well as our low unemployment rate and sheer number of jobs on offer. But what's likely to sort of be the landscape moving forward on that?
Yeah, so the rapid switch that we've seen in population growth, so Perth now has around about 120,000 more people in it than what we would have expected pre-pandemic. So a significant acceleration in that net interstate migration. And there's two factors. There's both the pull and the push factor. And unfortunately, Perth at the moment is losing one of those pull factors, and that is housing affordability. 25% increase in house prices in a 12-month period, 10% over the last year. That's unfortunate. Perth is just about caught up to Brisbane, just 10% below Brisbane now in terms of average house prices. And we can see that that's definitely a benefit for Adelaide at the moment. We can see a different dynamic at play in South Australia pre-pandemic to post-pandemic. And I think, unfortunately, Perth, that erosion, they're certainly nowhere near Sydney prices. But Sydney and Melbourne will continue to push workers out. From a building perspective, they are at a very low level of home building. Sydney is one of the very few areas, Sydney Basin is at a very low level of home building at the moment, will be forcing workers out. In fact, there are more detached homes under construction in Western Australia than there are more homes under construction in Perth at the moment. I'll go again. There are more homes commencing construction in Perth at the moment than there is in Sydney. And that's been sustained for a couple of years and likely to remain the case for the next 2 or 3 years. And so as Sydney pushes workers out, to a lesser extent, Melbourne, because of the cost of housing and because of the slowdown in home building activity, Western Australia, South Australia will be beneficiaries of that. Of course, the lion's share of that skilled trade is going to go to the southeast corner of Queensland. So with those push factors out of Sydney and Melbourne, and with employment growth in Perth likely to remain relatively stable, both from mining and from home building and from construction, then we're looking at the one we're really interested in is not so much international migration, but interstate migration is likely to be sustained at a relatively more stable rate than what we've seen for the past 20 years. So population growth in Western Australia hopefully will remain below that 2% annual population growth. National population growth at the moment is around 1.8%, with the bulk of that going into Sydney, Melbourne and Brisbane. But with WA drawing workers out of East Coast, a long-term population growth rate of 1.5 to 1.6% is a very rapid population growth rate, and one that's probably likely to be sustained for the rest of this decade.
Okay, interesting. So we've finally got the state election out of the way and the federal election out of the way. No longer seeing politicians' heads everywhere we drive around. What do you think is going to be the impact of the various policies we've ended up with?
Well, Western Australia, of course, is very unique in this situation. It's the one market where, more so than anywhere else, is labour force capacity that is constraining home building activity. So even if the government were to reduce costs, we won't see the volume of homes under construction increase. Now, in terms of federal government policies, there is negligible, nothing, very little at all that is going to impact on the supply of housing nationally or even in Western Australia. Plans to build 40,000 public homes, that's great. We do need more public housing stock, but of course, public housing stock makes up about 3% of supply. And so even at capacity, it's not going to tangibly change that supply and demand equation. It is the other 97% of the market that needs to be unconstrained. And from a federal government perspective, there are very few things they can do. One of the positives that came out of the federal election was all of the talk about infrastructure investment. So Labor Party talking about $10 billion investment in infrastructure, and that's a real positive. That is where the key issue lies. We will be talking about land supply for at least the next decade. And what we can see at the moment is that cost of land is increasing very rapidly. Whether it's for greenfields projects or brownfields projects, it is the major constraint. Now, the federal government subsidising the cost of state government of providing that infrastructure is a positive, but unfortunately in the ALP policy, they also talked about making that contingent upon first home buyers having access to buying that land. Now, I understand from the federal government's perspective, they see that they're subsidising a particular activity and therefore they would like something in return. But we've been through this cycle repeatedly over the past 20 years where a government will step forward and add money to bring development forward and seek something in return. And it's effectively the same as saying there's a tax concession on one hand and additional tax on the other. And as a consequence, nothing gets developed. And that has been the underlying problem. And I think they also need to see that they're not subsidising individual households, but in this case, when they're building infrastructure, they are subsidising what is a state government cost of provision of infrastructure. And that goes to one of our core issues, which is, and we talk about who pays to make water flow uphill is the key issue for increasing land supply. And that is, at some point in a development, you have to make water flow uphill. It is a metaphor for all of the other infrastructure that needs to come to bring a new residential, whether it's greenfields or brownfields. It is who pays to make water flow uphill that's the issue. In the 1980s, that was a consolidated revenue. It came out of the Department of Main Roads, or Main Works, whichever government department it was at the time. By the 1990s, we'd moved to more of a cost recovery basis or a user pays model. By the year 2000, we'd started to tax that as well. And now in Sydney, it is not just that the person who buys the first home is paying for 100% of the infrastructure up front. They are also paying for the upgrade to infrastructure for downstream users. They're paying for the provision of parks, transport facilities for other, not just their own suburb, but other existing suburbs. They're paying for the maintenance and servicing of that infrastructure in perpetuity, and then they are taxed on the provision of all of those. So they're paying for those people in the 1980s didn't pay any of the cost of that infrastructure, and now somebody that's buying a new house and land package will be paying 150, maybe 200% of the cost of that infrastructure. And it is them subsidising other households that is the issue. If we look at models on how to get through that, South Australia has certainly been one to look at. And just earlier or late last year, the South Australian Premier announced an in principle goal whereby a third of the cost of the infrastructure would be paid for out of consolidated revenue, a third paid for through existing water charges, and a third paid for by developers or therefore passed on to the household that builds the new house and land or new apartment. And that as a model would seem to be a much better model than what we have in certainly Western Australia and every other jurisdiction, desirable goal to work towards.
Yeah, well, that certainly gives me a greater insight into just how complex it is to create this extra land supply and why it's so hard. Yeah.
Yeah, well, the complexity and time. So if we look at Sydney as being the worst case scenario, and there it takes 15 to 20 years to go from a dairy farm through to shovel-ready land, whereas in Adelaide, that's about 4 to 7 years. Now, they're notionally the same dairy farms developed by the same companies, but the same costs, same infrastructure requirements, just why it costs $600,000 more in Sydney than it does in Adelaide is due to taxes, fees and charges, red tape restrictions. And so that is the key dynamic. And because we've spent 20 years building all of those up, it's very hard to get past that. And talking before about Sydney building fewer homes than Perth, but that is also the state government's goal. Their goal is only to build 22,000 new homes in Sydney, as opposed to Perth building at the moment just over 22,000 homes per year. So however they have such unambitious goals, they will only just manage to achieve them.
Just real quick before we continue on with the episode, are you getting my email updates yet? If you're not, you're missing out on our suburb intelligence reports, which we tailor and prepare for your individual suburbs of interest, showing advanced stats and insights. Must get onto those. And I also send out exclusive invitations to our events, including webinars, sundowners, and workshops. So if you're not getting those, head on over to investorsedge.com.au/join and make sure you're receiving my email updates.
Well, before we go deeper into the actual housing market dynamics, I wanted to understand a few of the other impacts from all these higher level things that are going on. So we saw that foreign investors were banned, I think, for a 2-year period. Like, do you see that having much of an impact? And it's not just always on the taking up of housing to live, but also their impact on funding projects, from what I gather.
Yeah, so look, we need to define things out very clearly here that foreign investors are not international students. They are different things. And what has occurred is that we have allowed demand to grow through a growth in population, but state governments in particular and the federal government as well have taxed capital. So they have stopped the flow of money coming in to build homes for that increase in population. So essentially they've allowed demand to grow unconstrained and they've really constrained the ability to supply. And it's very perverse because it's the worst own goal of any housing policy. It reduces the amount of revenue the government raises and at the same time puts increased pressure on public housing stock. New South Wales, again, is probably the worst in that scenario, at around about $100,000 to $120,000 the cost of a new apartment if the capital is coming from overseas. So whilst we're allowing overseas students in, we're stopping institutional investors, superannuation companies, banks that are overseas owned from building apartment complexes in Australia. And it's a very bizarre and perverse outcome. And I'm hopeful that over the course of the next year or two that a few state governments will begin to work out that they will raise more revenue if they remove those taxes.
Mm. Well, I guess we think about just foreign investors owning single, detached houses, but where the problem probably exists more so is what you hinted at there of the institutional lending being, I guess, needed to contribute to funding some of these projects and getting them off the ground. And now that capital's not there, where are they getting it from?
And from a productivity perspective, 1 in 10 detached homes in Australia are built by an overseas-owned business. And those overseas-owned building companies bring with them advanced manufacturing techniques, productivity management skills, and products. And if we tax them out of the market, as we have done, then we're going to miss the opportunity for that next wave of investment in new building technologies as well. And it's really important to distinguish between overseas students. We shouldn't, if the government wants to restrict overseas students renting or buying a house, and keep in mind, the impact on demand is the same as whether an overseas student buys or rents a home. It's just still one dwelling unit for that student. The issue isn't whether they rent or buy. And foreign investors have been prohibited from buying established homes in Australia since 1975, with very good reason. We don't want the established housing market to be a plaything of global financial markets. But taxing the capital, the money that flows to build those homes for overseas students, results in the worst possible outcome.
That makes sense. One of the other outcomes that I was scratching my head about, and it's fabulous on an idea for first-time buyers to get a whole bunch of help into housing, but what do you see happening with the various, I guess, incentives you can call them or support measures that the government has, in many ways, rolled out in order to gain election votes and from that younger demographic?
I think realistically there is very little there. There's nothing that's moving the dial at this stage.
Okay.
The infrastructure program, if it follows through, will have an impact, but it will take at least a decade before we see an increase in supply or a lower cost of land coming to market, probably more like 15 years before that has a positive impact. The coalition, of course, had a policy which would provide mortgage deductibility for first-home buyers.
That was an interesting one. Never seen anything like that. Yeah.
Yeah, well, it was curiously a policy that was raised by Gough Whitlam in 1973. It's the only other time we can find it. So a curious policy announcement. But
I'm not sure the average first-time buyer understands the necessary benefit of that or not either. It's a complicated one for people to get their heads around.
Very true. They would have understood $50,000 per year every year for 5 years. They would have eventually understood that, and it was an enormous. You can criticise it for being expensive. It would have been expensive. You can criticise it for being regressive because technically it is regressive. Anytime you adjust income tax arrangements, the policy will be regressive. But what it would have done was significantly increase the volume of new homes commencing construction, initially as detached and then as apartments, and we would have substantially increased the supply of homes. In the short term, the only thing state and federal governments can do to increase the supply of housing and ease that burden is to subsidise the cost. Long term, we wanted them to reduce the costs that they've built in. 50% of the new house and land package is taxes, fees and charges. Reducing the time frame to bring land and housing to market and reducing the tax imposts is the end goal. In the short term, the only thing they can do is turn some of that revenue they raise into subsidies for whether it's first home buyers, public housing, owner-occupiers, regardless. That's the only thing they can do in the short term. And so that would have been a positive to overcome some of the barriers we have at the moment. And of course, home building at the moment, detached homes, we've started our lowest volume for more than a decade, and we've done that now for nearly 3 years in succession. And we have started a very small volume of apartments nationwide over the course of the past 3 years, so less than half of what we're building a decade ago. And that locks us into, we now know that we have 3 years where completions are going to be very low, and at the same time, net overseas migration is likely to exceed 250,000 per year. So the consequence of that is that we know every year for the next 3 years that demand for housing is going to exceed supply. And that is, from a political perspective, means the next election is going to be very dangerous from a policy perspective, because as that gets worse, and we'll be heading for a third term if re-elected for the Albanese government, they will have to be taking some responsibility for the outcomes that have been achieved there.
Interesting. Well, to change gears a bit, I was hoping to get your larger view on what a project like AUKUS is likely to do for Perth and its economy, because I don't think we yet really understand just how big this is going to be. And can you speak to and give us some perspective on that?
Yeah, I think the first thing to always note with any defence project is that it will run behind schedule. That's not based upon any foresight, just typically that's what occurs. And secondly, then such a project as enormous as this, that's almost always happens. So the second thing to say then is that we look around the country at what we call unicorn cities, and they're particularly Townsville, Wagga Wagga, Newcastle, and they are cities where there is a large university, a large hospital, and a large military base. And we can see them from those regional towns that when there is an economic contraction, that ongoing public expenditure provides certainty and stability to population growth. Without going into it in a lot of detail, those three regional communities outperform any other regional community in terms of long-term economic growth, house price stability. And it is that public sector income streams that change the dynamic. Now, we can see that in Adelaide now too. I was talking about Adelaide before, is incredibly stable now, and it is particularly when you have a household that has one public sector income in times of contraction, they remain in place during that economic downturn. They don't pack up and leave, like we saw in Perth post-2015. So that enormous capital investment, whether it is Australian government money, US government money, UK government money, will bring a level of economic stability and certainty to the Perth market that it hasn't seen in the past 25 years. When it comes, is less certain. And I don't think, strategically, when you look at all, again, back to, there's no such thing as geopolitics, only energy prices. When you come back to that, I don't think that there is anywhere else strategically that infrastructure can be built to achieve the outcomes that the three countries would like to achieve.
Well, great. That's good news. Very, very good news for Perth. And I guess it's going to flow out over the next 5 to 10 years. And we haven't really even seen it scratch the surface yet then.
Yeah, and I think another component, the building companies are certainly acutely aware of what's coming there. And I think you can see them all shaping their businesses to start to service that market. Western Australia, more so than other building companies as I travel around, have prefabrication businesses, pre-assembled or tiny homes. They go by a variety of different names. But the level of consolidation and vertical integration in the West Australian market is unique for residential home building. I think that they're well placed to significantly increase a particular type of dwelling, off-site constructed prefabricated dwellings, far better than anywhere else in the country.
Interesting. Well, I didn't think we were going to talk about that today, but it is part of the challenge, isn't it? That it still costs so much even to do tiny houses and to get them in place. And I just feel like there has been a reluctance to look at alternative building methods, especially in Perth. We like detached houses, we like double brick, but people are going to have to start looking at these. What's your sort of take on where that space is heading? And, if we could open that up to allowing granny flats for actually a cheaper cost, what I'm sort of seeing is the cost of those has still increased substantially for the ancillary dwellings, and all we've gained is a time saving, but not yet really any kind of cost saving to make it worthwhile for an investor who listens to the show to think about popping one on the back of their property and actually increasing the housing supply.
Yeah, so the past 5 years have come with a problem, not only rapid increase in the cost of building materials and labour, we've also seen a range of additional regulatory costs. So the cost of building a house went up 30 to 50% over 3 to 5 years, depending on how you want to look at it. And when we have to get over that problem, I'm hopeful now that governments have learnt the lesson of National Construction Code changes that have come into play, that added about $25,000 to the cost of building a new house or a new apartment. And I'm hopeful that with a period of time where they don't continue to add to those costs, that we'll see that material prices are very stable. Labour prices are going to continue to grow while we have 4% unemployment. But as Perth established prices rise, and particularly when apartments in the city catch up to the cost of construction of a new apartment, which is just a matter of time, then we reach a tipping point in Perth where some of those changes come on quite quickly. You mentioned double brick there. There is a point in time where Perth is going to have to move for the volume home building component, and particularly for the medium density. And that's just a matter of time before Perth starts. It's a very spread out city, and the opportunities for increasing density, 2 and 3 floor type dwelling, will come about before we see a tangible increase in those multi-unit apartments in the city. And so I think that there will be a point at which we see a fairly significant switch out of nationwide. It's about 10 to 12% of the market is steel, and the bulk is timber framed. And of course, in Western Australia, it's much more like 70% are double brick and 20% timber framed. But I suspect that we're going to see a sudden switch, and it will be a combination of moving from to more higher density and the acute shortage of labour that sees a switch to those highly vertically integrated businesses that are much more common in Western Australia than we do elsewhere. And so I think the move to prefabrication will happen here before we see it East Coast.
Interesting. Now, to jump up to probably the last high-level hot topic is interest rates. We had our first reduction in February, just to whet the appetite a bit. Most economists, I think, were expecting a 0.5% reduction in May, and we got a 0.25. Where do you sort of see that heading and impacting the property markets and overall economy?
Yeah, so two things, cyclical versus structural. So yes, interest rates are coming down for cyclical reasons. Inflation went up because of global pandemic. It's come down because of global reasons, and it's back within target bands. So the cash rate will come down over the course of this year, maybe into next year. Just quite how many rate cuts we get, of course, we don't know. But the structural component is the one to be concerned about, which is an economy that is built off population growth and government expenditure leads to high inflation. And so those structural components we're concerned about. Now, they don't become a factor in the next 2 years. Maybe in 3 years, they will start to have an impact on inflation. But long term, between now and 2030, we expect to see inflation, and therefore the cash rate will be higher than what it was pre-pandemic. So we have a cash rate at the moment of about 3.65. And remember, it was pre-pandemic, it was 0.75. We're not getting back to that 0.75% cash rate because our economy is now driven by population growth and government expenditure. So yeah, at least one, probably two more cuts this year, maybe some more early next year. And that is a very simple story then when we see interest rates come down. House price growth will occur as households are able to spend more money. We get a positive wealth effect coming out of that. We will see an increase in renovation activity as households are able to borrow against their capital as house prices grow. We'll see demand for skilled labour continue to grow. It will be a very positive thing for home builders and building businesses. From an equity perspective, of course, that is not a good outcome. Those concerns around political issues coming about from a rise in the cost of home building, they will continue to mount over the course of the next 2 years as a consequence of that cut to cash rate. For Western Australia, Western Australia has been catching up house price wise for the past 5 years. You've nearly caught up to Brisbane, but what happens now is that you're going to catch the national tide. And for the first time in, I'm not sure when, Western Australia is going to join the national economy on a cycle of house price growth after 20 years of moving against being counter-cyclical. And so
that's going to be surprising, yeah.
It will be. So prices in Perth 10% below what they are in Brisbane, probably a natural equilibrium. So we're likely to see 5 to 10% growth in house prices over the course of the next 12 months as a result of that cut to the cash rate. And Perth will likewise see something similar.
Good to know. So the other part to that is what's happened with the buffers that the banks are applying, and we've still got the 3% buffer on that they're testing and really being very risk adverse. Do you see that changing at any point? And is there discussions or any sort of pressure on that changing, or do you think they're going to hold out and leave that where it is?
Look, I'm very surprised that it's still in place. The UK removed that 3% buffer around 3 years ago. Now, the 3% buffer gets a lot of attention, but there is also another 15 years worth of additional costs that have been loaded into macroprudential restrictions since 2007. Australia and first home buyers are paying a very high price for that. And they would certainly have a positive if they were changed. I don't get the sense politically that there is the desire to move on those topics at this stage. And I think that they would like to address supply first and see supply rise to a point that matches demand before they start to ease those macro restrictions. I am somewhat sympathetic to that argument. However, those that are bearing a price of this are first home buyers. And if we have a market failure such as that 3% buffer, which is not effectively protecting anyone at this stage of the cycle, and we have such high costs to banks for lending to first home buyers, and we've gained nothing as a consequence of making it more expensive for banks to lend to first home buyers. Mortgage arrears in Australia pre the GFC was very close to zero. Throughout everything that's happened in the past 15 years, mortgage delinquency in Australia remains extraordinarily close to zero. The Australian banks could withstand a very significant reduction in house prices and still not be financially unstable. So I think that there are some market failures there to be addressed, but I'm not sure that politically anyone is stepping into that field soon.
I guess it more seems to impact the demand side of the equation, and they haven't got any kind of solution even coming for the supply side of the equation. So, yeah, it makes sense that they wouldn't probably touch it.
We'll see. I'm hopeful, but I've not seen anything to suggest that the Reserve Bank, Treasury, APRA or ASIC are looking to reverse any of the initiatives that they've introduced.
Okay. Well, I thought we'd finish by going a little bit deeper into some of the, I guess, factors around what it costs to deliver a house. Where are we at with labour shortages and the cost of that contribution to building a house at the moment?
So if we break it into three, material prices is now relatively stable. We have some particular issues around some particular commodities, and it's energy intensive. It's probably increasing in price faster than CPI, but some of them are falling as well. Steel's coming off at the moment. Labour, while ever we have 4% unemployment, is going to increase in the construction sector faster than it is nationally. That's good for us to attract more apprentices. Hopefully, we'll be able to gain access to overseas labour at an increasing rate. But rates of pay, I would imagine, probably grow at twice the speed of what we're seeing average wages over the course of the next few years. But the elephant in the room is land prices. And cost of land in Perth has increased by about 30% over the past 18 months. And that is very unsustainable. And it is that infrastructure investment that's needed to bring that land to market at a price that households can afford to get a new house and land package or a new apartment to market at as low a price as possible.
Makes sense. I guess when we then think about some of the other challenges that we face, we mentioned for the high density, the funding challenge is there seems to be a lot of other, I guess, challenges with perception of not in my backyard movement. How do you see these problems getting solved, if at all? And what are some of the things we're going to have to look at to try and actually change what we're building higher density wise to create more housing supply?
So I think for Perth, there are two types of problems. Problems time has solved and problems time will solve. And the apartment building in Perth is just waiting till that established apartment price rises to the point at which the new projects are affordable. There's a large volume approved and not yet commenced, but I think that we are 2 to 3 years away from that occurring. There's still a large enough volume of established apartments on the market in Perth that are available at a price well below what new can be delivered. And so if that cycle's starting in 2 or 3 years' time, then it is 5 to 6 years before that apartment cycle reaches completion. It's only when we see 2 or 3-fold increase in apartment construction in Perth that we will start to see supply meeting demand.
That makes sense.
Yeah, detached market can't do all the heavy lifting there.
I guess what we've seen in Perth, and I wanted to sort of ask this question to round up everything you've said today, because I haven't heard anything that's overly negative at all. It almost seems like the next 3 to 5 years is fairly written, and it's going to be hard to change the course that we're on in terms of increasing supply, increasing population growth. We're a lot more stable as a Perth and West Australian economy, where all of that sounded very positive. We've had a big increase in prices in the lower end. That's starting to flow through to the middle as people upgrade and use that equity that they've got. Over the last 3 or 4 months, especially around the elections, we had a more of a cooling market. A lot of people are asking themselves, is Perth done? Should I get out of Perth? What do you, I guess, see ahead as far as house prices go over the next, 2 to 3 years? Where does this all point to?
I suspect that within the 3-year time horizon, Perth will actually reach a point where house prices will slow back to that 0 to 3%. And that happens after any period of rapid house price growth, you will get a period of short house price decline. Now, Perth is going to have a little bit of price of confidence when that happens. And I'm only suggesting it will happen because that's what we see. Sydney, Melbourne, Brisbane go through periods of rapid price growth, short 6 months of decline. We've just gone through that. In Melbourne, Canberra in the last 12 months, but it's replaced by another period of rapid house price growth. It's just going to take Perth a little while to get used to that. And that moment that we see a pause in house prices in Perth, I think this market will talk itself into its own little mini crisis for a short period of time before those fundamentals of supply and demand kick in and people realise that rental vacancies are extraordinarily close to zero. It's going to become increasingly cheaper to build or buy than it is to pay rent, and that cycle will continue for some time. So the next 3 years, ongoing price growth, albeit at a slower rate.
No, well, I've certainly appreciated getting your insights on everything today. We danced all over the place from the economy to the housing industry. So I really appreciate you joining us, Tim, and I'm sure there's a lot of takeaways for our listeners there.
My pleasure, anytime.
And if you've liked today's episode, do share it with a friend, hit the subscribe buttons. And every day we're hearing from listeners who want help with their strategic plans, with their buyer's agency, property management and sales. So reach out for a chat and see if we can help you Thanks for tuning in, and catch you on the next one.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.